Hello, everybody. Pierre Narmado here from Talbot and Associates. I'm a partner here at TNA. I manage our St. Boniface office on Provencher, and I also head our Trusts and Estates department. Today, we're going to talk about taxes upon death. And while that topic can make some people cringe, it is very important that we understand the tax implications of dying. So we're going to give you a few minutes to get yourself organized and settled, and we'll get started in about a minute. Okay, welcome back, everybody. So as mentioned, we're going to talk about taxes upon death. And so there's quite a few things that we would need to cover to make this a comprehensive session. So I've come up with a list of the top 6 things that you need to be aware of as it relates to taxes upon death. So I encourage you to ask your questions, maybe post them as you go, and we'll do our best to answer every single one of them. So before we get into the top 6 list of things, I want to cover a few terms that we're going to cover throughout this live presentation. Number one, the final tax return. So the final tax return is that return that's filed in the year someone passes away. So we're talking January 1st up until the date of death, okay? Now, an estate is all the wealth of the deceased that passes all the wealth of the deceased that passes to the estate. And so the estate starts on the day after the date of death. So say the date of death is December 15th, we would have the final tax return that would go from January 1st to December 15th, and the estate would start December 16th and would continue until all assets are either sold or distributed to the beneficiaries. The other thing I want to mention, or the two people that are important in this relationship when we talk about taxes upon death is the executor, and so that's the person named in the will to administer the estate, and the beneficiary. And a beneficiary is an individual that will benefit from a deceased person's wealth directly or indirectly through an estate. So now we're going to get into our top 6 list of things that you need to be aware of when someone passes away. So number 1, deemed disposition. So when somebody passes away on their date of death, it's as if they sold all of their assets, everything they owned, at fair market value. And so that is considered a deemed disposition. You're not actually selling those assets, but it's as if you sold them for tax purposes. And so whatever the cost was, whatever you paid for them, whatever the cost was when you acquired that asset, well, now it's as if you sold it at fair market value on that date of death. So we're talking house, though that would likely qualify for principal residence exemption. We're talking rental properties, investments, RRSPs, RIFs, everything. All assets are deemed disposed on the date of death. Number 2, automatic spousal rollover. So if you have a surviving spouse, there's an automatic rollover of assets to your spouse, which eliminates number 1. So assets are transferred from the deceased on date of death to that surviving spouse. And when we say rollover, it's called a rollover because it's transferred at cost, so not at fair market value. So when you don't have a surviving spouse, deemed disposition of assets, huge taxable event. When you have a surviving spouse, those assets can be rolled over to that surviving spouse. So, and eliminate the taxable event. Now, while there's an automatic rollover, we can opt out of that automatic rollover. And so that's done on an asset by asset basis. So if you opt out, you don't have to opt out for all assets. You can opt out on each individual asset if you'd want. And why would somebody want to do that? Well, say somebody passes away on January 5th, and that final tax return has 5 days, only 5 days of income. So it's likely that the income in that final tax return will be very low. So one thing we'd want to do is opt out of the rollover on maybe some of the assets, increase the income on the final tax return, and take advantage of some tax credits that would otherwise be lost. Now, number 3, probate. So what is probate? Probate is a legal process that ensures the administration and eventual distribution of assets is compliant with the deceased's wishes and is compliant with the provincial tax law. A probated will may be required for an executor to gain access to certain funds or assets, and some financial institutions will require a probated will. Now, we're not talking about a big fee in Manitoba, so it's a low 0.7% fee. So an estate that has wealth of $10,000, we're looking at $70 of probate fees. For an estate with $100,000, $700 of probate fees. And with an estate of $1 million, $7,000 of probate fees. So it's not a big amount. Now, some of you may say, well, I thought probate fees were eliminated in Manitoba. It was announced in December 2019 that Manitoba probate fees were set to be eliminated effective July 1st, 2020. But the bill has not yet received royal assent. I don't know if that's COVID related, but it hasn't received royal assent yet. But the expectation is that probate fees will be eliminated in Manitoba eventually. Now, it's important to note that probate fees only apply to assets that transfer into an estate. Okay, and there's a way that assets can pass on from a deceased individual to a beneficiary directly, and that's done through a direct beneficiary assignment. With RRSPs, you can assign a direct beneficiary. With RIFs, you can have a successor annuitant. And so that's, and even other investments, you can have investments jointly held, and that would also avoid probate. And so some people do that to plan around probate and avoid probate fees. Now, my opinion is that probate fees in Manitoba are fairly low. And so sometimes it's not worth trying to plan around the probate fees because that can result in more income taxes being paid in the end. So that leads us into number 4, direct beneficiaries and joint ownership of assets. So like I said, some assets like RRSPs and RIFs can have direct beneficiaries assigned to those accounts. Some investments or properties can be held jointly. So first, we're going to talk about joint ownership with right of survivorship. And so sometimes you'll see that in the acronym JTWROS. And so basically what that means is each owner has an equal undivided interest in the property. So if one person dies, if one owner dies, the remaining owners receive an equal portion of the deceased person's share. So there is still a deemed disposition on death. And so if there's no surviving spouse, and even if there is a surviving spouse, when there's joint ownership with right of survivorship and the joint ownership is not the surviving spouse, there would be a taxable event on that final tax return on death. Now, in general, assets held joint ownership with right of survivorship are not subject to probate fees. And so that's one way to avoid probate for that asset. But the biggest difference on a joint ownership with right of survivorship is how the adjusted cost base for the remaining owners is affected. And so it essentially increases their adjusted cost base. So for example, say we have 3 owners, and so they each paid $1,000 to acquire a property. And they all hold 1/3 of the property. And say the property is now worth $9,000. So ACB, adjusted cost base for the total property, is $3,000, $1,000 each. Fair market value is $9,000. And say one owner dies. Well, fair market value for that owner will be $3,000 for their portion. Adjusted cost base would be $1,000, and so you'd have a capital gain of $2,000. That would be reported on the final tax return. The remaining owners each receive an equal portion of that deceased person's share. So now the new owners, because there's only 2 that are left, will own the property 50-50. The ACB for the remaining owners will be $2,500. So take their original $1,000 plus 50% of the deceased person's value at fair market value. So 3,000, 50% of 3,000, 1,500. So now their new ACB for the remaining owners is $1,000, their original ACB plus the 2,500. And they own half of that property. They own 50% of that property. So now their fair market value, because the total fair market value of the property is $9,000, their fair market value for their portion is $4,500, and their ACB is $2,500. So total ACB after death, total ACB for the property, $2,500 for each owner, and $4,500 for each owner. So total ACB $5,000, total fair market value $5,000. And the reason I'm mentioning that is because you'll see on the next point, it's similar but slightly different. Now, the other type of joint ownership is tenancy in common. And so this refers to assets held in common by one or more people. So say one owner passes away, their share of the assets goes to their estate. It does not go to the remaining owner. It is a deemed disposition on death, and so it is taxable. It's reported on the final tax return. And in this case, this particular asset would be subject to probate because it passes through the estate. Now, the adjusted cost base for the remaining owners for tenancy in common does not change. So take our previous example where you have 3 owners, but in this case, it's tenancy in common. So the adjusted cost base for each owner is still $1,000. The property is now worth $9,000, like the previous example. One owner dies. Fair market value for their share, $3,000. ACB for their share, adjusted cost base for their share, $1,000. We still have a capital gain of $2,000. That's reported on the final tax return. But in this case, now the asset passes to the estate with a cost of $3,000. Because the final tax return reported the gain, the fair market value of $3,000, the adjusted cost base of $1,000, the fair market value of that asset becomes the cost for the estate. So now the cost for the estate, the adjusted cost base for the estate is $3,000 for that particular asset. For the other owners, their ACB is still $1,000 with a fair market value of $3,000 each. So the remaining the remaining 1/3 owners, because now it's still 1/3. The estate owns 1/3. One owner, the remaining owners each own 1/3 each. So now their fair market values for their portion, $3,000. The adjusted cost base for the other 2 owners is $1,000 each. For the estate, fair market value of $3,000, adjusted cost base of $3,000. Now, total ACB, when we calculate across the board, $3,000 for the estate, $1,000 for one owner, $1,000 for the other owner. Total ACB for the property, $5,000, which is the same as the previous example, just split out differently. Fair market value for the asset, $3,000 for the estate, $3,000 for each of the other 2 owners. So $9,000 in total. Again, the same as the previous example. So the total numbers don't change, but the allocation of the ACB does. Now, parents will sometimes add children as joint owners of certain assets investments. And that's done for 2 reasons in particular. One, to ease the administration of that particular asset. We call that legal ownership. The other reason is to avoid probate. So if you have an asset that's held jointly, it'll pass on to the remaining owner when that person passes away, and it avoids probate. Now, the third reason why you would add somebody jointly in joint ownership would be to actually share beneficial ownership with that individual. That's done rarely, but it does still happen. But now adding that joint owner can trigger a tax event when you add them as a joint owner, because it's as if the original owner has a deemed disposition for the portion that they were giving to that joint owner. Now, when people add joint owners to their property, to their investments, it can trigger a tax event, but we always have to ask the question, why was this done? Was it done for legal ownership and to ease the administration of the asset, or was it done for beneficial ownership and to actually share the beneficial ownership, the profits, the revenue of that particular asset? So when we prepare the tax return for a deceased individual, those are always questions or things that we clarify. If a joint owner was added for legal ownership, then the full deemed disposition is reported on that final tax return for the original owner. If that person was added as joint owner for beneficial ownership, then a partial deemed disposition of that asset is reported on that final tax return. For RRSPs and RIFs, rather than joint ownership, it's called successor annuitants. In some cases, it's called successor annuitants for RIFs. And for RSPs, direct beneficiary designations. So these are things that can be done through the financial institution itself to assign a direct beneficiary for the RIFs and or RRSPs. So to summarize the general advantages of direct beneficiary or joint ownership designations, it gives no uncertainty as to who gets the asset when somebody passes away. It goes directly to that beneficiary, to the remaining owners, and it does not pass through the estate. It avoids probate, and so that's another advantage. The disadvantages are that a direct beneficiary of an RRSP of a RIF could be responsible for estate taxes. So say, for example, all the wealth of an individual is tied to RRSPs or tied to a RIF. And when they pass away, they are deemed to have disposed of that RIF and that RRSP. And so that's taxable event on death, no surviving spouse. So that could be a high tax bill on the final tax return. But because there was a direct beneficiary assigned to that RRSP account, that passes on to an individual directly. And so now there may not be enough cash to pay the taxes on the final tax return. So the RRSP beneficiary in that case could be held responsible for the taxes for the final return. Other disadvantages to direct beneficiary designations: the executor loses control over the asset, and that could lead to an unfair distribution of estate wealth to beneficiaries. And it also gives us, the accountant, less flexibility for tax reporting and less tax saving opportunities. The fifth thing I want to bring up is estate assets. So we talked about there being a surviving spouse and how assets will roll over to the surviving spouse. We talked about direct beneficiaries, joint ownership, and how assets will be distributed to those individuals should someone pass away. But if we don't have a surviving spouse and we don't have direct beneficiaries or joint ownership, then the asset goes to the estate. Now, things to note here are that assets held by the estate stay in the estate until they're either sold or distributed to beneficiaries. The assets are administered by the executor with instructions in the will. Assets can earn income while held by the estate and reported on an estate tax return. The first 36 months after the date of death, so earlier we talked about how somebody passes away on December 15th, that final tax return will report income from January 1st to December 15th, and then from December 16th until assets are either sold or distributed to the beneficiaries, they'll be reported in the estate. Well, the estate has 36 months to either sell the assets or distribute them to the beneficiaries until it no longer qualifies as a graduated rate estate. And a graduated rate estate is basically an estate that has graduated tax rates just like an individual. After the 36 months, the estate turns into what we call a non-graduated rate estate or a non-GRE. And so income reported in a non-GRE is taxed at the highest rate of 50.4%. So it's best to distribute assets before that 36 months passes. So the final point that I want to talk about here is donations. And so if someone is wanting to donate a portion of their wealth upon death, it's best to do so through their will. Specify donations within the will. Why? Well, it gives the executor more flexibility in claiming the donations and maximizing the credits that can be claimed on tax returns to reduce taxes on either the final tax return, the year before the final tax return, or any estate tax return. If donations are made that are not specified in the will, then those donations must be reported on the final tax return only, and credits could be wasted. So those are the top 6 things. I know we kind of ran through it pretty quickly. There's a lot of things to cover here, but I felt those were the 6 biggest things to cover as far as taxes upon death. So now we'll open it up to questions and see if we have any.
Hey, Pierre.
Hey.
All right. That was a tough topic, but that was some really great information.
Yeah, no, there's a lot to cover there, that's for sure. So
we did have a question from Lucy.
Okay.
Say one of my parents passes away and they owe taxes to CRA. What happens to that? Would I be responsible for that?
And Lucy is the executor here we're talking about?
Let's say so for the question.
Okay. So Lucy, if Lucy's the executor, she's responsible to make sure that all the taxes that are to be reported, to be paid on the final tax return and the estate, that those are addressed. So the cash that's received by the estate would be responsible to pay the taxes. So it's not necessarily Lucy's responsibility. It's not necessarily that she pays the taxes. It's the estate, the leftover wealth of the estate that would pay the taxes.
Perfect. That makes sense. All right. So let's keep the ball rolling on that topic. Say the worst does happen, you do lose a parent. How soon after should you talk to your accountant?
Yeah, that's something that we try not to push it too much. I would encourage individuals to let us know that someone has passed away. Give us the date of death. We could give them an idea of timeline, things to look out for. I mean, you want to notify CRA as soon as possible, just to stop GST payments, possibly CCB payments, just to make them aware that that their parent has passed away. But we certainly want to give them time to grieve and deal with, you know, all the things that come with losing a parent. So not too soon, but maybe just notify us as soon as possible, and then we'll kind of let them know when things need to be addressed.
Absolutely. So, on the topic of being maybe a bit more proactive, what if you can see the situation on the horizon and you're the executor? What kind of steps could you take to start preparing?
I would encourage executors. This is something that I've done even with my parents. I would encourage them to talk to their parents, or if they're the executor of their parents, then you know, it's their parents. If they're the executor for somebody else, then it's talking to that individual, getting an idea what assets they hold, what are their wishes, is it clearly specified in the will. I would encourage that discussion, but otherwise, you know, if we're talking about estate tax planning and trying to minimize tax upon death, then maybe it's looking at, well, what are they reporting for tax purposes while they're alive? And maybe we can increase that income while they're alive, and as a way to reduce the possible income that's reported on death, and reduce the income that's reported upon death, and reduce the taxes on death, and increase the income while